Here we will talk briefly about non-sovereign bonds, quasi-government or agency bonds, and supranational bonds. Non-sovereign bonds are bonds issued by states, provinces, cities, municipal authorities. So they are government bonds, but these are not national governments. They are not federal governments. The credit rating of these bonds will be lower than the credit rating of sovereign bonds, and this credit rating actually varies a lot. The credit rating will depend on the collateral, it will depend on the taxing authority of the entity which is issuing the bonds. It will also depend on the other projects that this entity might be doing, and at a high level, the money that is used to pay investors will come either from taxes or some sort of projects. In doing the credit analysis, we have to consider the taxing authority of the entity and the ability to impose taxes for bonds where the funding is coming from projects. These bonds are called revenue bonds, and there obviously we need to evaluate the cash generating ability of the projects. Quasi-government or agency bonds are bonds issued by agencies. You can think of agencies as entities which are established by the government and they are meant to perform a certain function. In the United States, for example, the Federal National Mortgage Association, or Fannie Mae, is an agency. The bonds issued by this agency would be called agency bonds. Agency bonds generally have low credit risk. The reason is that historically default rates have been very low. Another reason is that many of these agencies are backed by the government. So they have either implicit or explicit government guarantees. In terms of making payments to investors, the money comes from the operations of the agency. Supranational bonds are bonds issued by entities such as the World Bank and the IMF. They are government related in a sense, but not tied to a specific national government. Let's look at example 5 now. Relative to sovereign bonds, non-sovereign bonds with similar characteristics most likely trade at a yield that is lower, same or higher. Remember, non-sovereign bonds will have a higher credit risk and investors will therefore demand a higher yield to compensate for that higher credit risk. So the yield is going to be higher. Bonds issued by a government agency are most likely repaid from the cash flow generated by the agency. So that looks right, but let's look at the other options. Guaranteed by the national government that sponsored the agency. This might be the case, but it is not necessarily the case. So we can put a question mark here. Backed by the taxing power of the national government that sponsored the agency. That is generally not the case. Agency bonds are backed by the cash flows that they generate. So the best answer is A. So far we have talked about the government and government related sector. We now switch gears and talk about the corporate sector. Companies can raise money or borrow money in different ways. One way is to simply borrow money through a bank. So that would be a bank loan. On the next slide, we'll talk about what syndicated paper means. Companies can also borrow by issuing commercial paper, and companies can borrow by issuing commercial notes and bonds. Let's look at bank loans and syndicated loans. A bilateral loan is a loan from a single lender to a single borrower. So if a given company goes to a bank and borrows, that is a bilateral loan. A syndicated loan is a loan from a group of lenders called the syndicate to a single borrower. Very often they will be the lead bank, which then also loops in other banks, and the collective entity that is lending, or the group of banks, they are referred to as the syndicate. A few general points here. Most bilateral and syndicated loans are floating rate loans. The reference rate could be any rate, but generally it is the interbank offer rate, and then there is a spread which is charged over the interbank offer rate. That spread is based on the credit worthiness of the borrower. For highly rated companies, both bilateral and syndicated loans can be more expensive than bonds issued in financial markets. And I'll put this with a caveat. This also depends on the country that we are talking about. In countries where financial markets, capital markets are well developed, this is definitely true. In other countries where capital markets are not that well developed, most companies don't really have much of a choice and will have to rely on bank loans and syndicated loans. Commercial paper is a short-term unsecured promissory note issued in the public market or via a private placement that represents a debt obligation of the issuer. Roughly speaking, this is the corporate equivalent of a T-bill because it is short-term. Commercial paper is a valuable source of flexible, readily available, and relatively low-cost short-term financing. The largest issuers of commercial paper are financial institutions, but some large non-financial companies also issue commercial paper. Commercial paper is often used to raise money for working capital or raise money when there is a high demand for cash. Commercial paper is also a source of bridge financing. What that means is if a company needs money to build a large plant, for example, or needs money for a substantial expansion, and let's say that it will take time to raise sufficient amount of money, then commercial paper can be used to raise money in the interim. So it is in a sense a bridge till the time that money can be raised through, let's say, a large scale bond issue. I made a comparison between commercial paper and T-bills, where T-bills are short-term government instruments. The yield on commercial paper will be greater than the yield on short-term government bonds. The reason is that commercial paper will come with some credit risk. Since we have a corporate entity issuing commercial paper, there is a risk of default. The risk will vary from entity to entity, but there is a risk. So because of that credit risk, investors will demand a higher yield when they invest in commercial paper. There is also liquidity risk. If an investor buys commercial paper and is not able to easily sell that paper in the secondary market, then there is a lack of liquidity and investors will demand a premium or a higher yield because of that lack of liquidity. I have mentioned the fact that there is credit risk associated with commercial paper, and in fact the three major rating agencies do issue credit ratings for commercial paper, and you don't need to remember everything on this excerpt, but here are the sorts of ratings that are assigned. Commercial paper which has a rating of adequate or better is generally called prime paper, and this is considered investment grade. Rating agencies generally require that issuers of commercial paper do secure backup lines of credit because this helps reduce credit risk. Another term that you need to know is the rolling over of the paper. What this means is that if we have a 9-month commercial paper, after 9 months when money needs to be paid back to the investor, then the issuer might issue another commercial paper and use the issue proceeds to make this payment. When that happens, we say that we are rolling over the paper, or the issuer is rolling over the paper. Commercial paper has traditionally been used by larger, more stable companies, and also historically the default rate has been quite low for commercial paper. We now look at the difference between US commercial paper and Euro commercial paper. The differences are highlighted here in Exhibit 8. I will emphasize the most important difference. US commercial paper charges interest on a discount basis. This is analogous to what you see with T-bills, whereas Euro commercial paper charges interest based on a add-on basis. This is what you will see with LIBOR-based loans. This distinction is important, and it is something that you also see in other parts of the course, but very simplistically, a discount basis means that we have a rate which is quoted as a discount relative to par value. So let's say that we have a 180-day US commercial paper and the par value is 100. If this bond is issued, if this commercial paper is issued for 95, then the interest amount is 5, and to calculate the rate we do 5 divided by 100, which is the par value, and then we annualize. So note that the interest is being compared with the final par value. Whereas with Euro commercial paper, if the principal amount is 100, then the interest will be based on the loan amount. Here the loan amount effectively is 95. So that is the high level distinction. This is something that you see in more detail in other parts of the curriculum. But if you are confused about this, then you can take a look at Exhibit 9 in the curriculum, which runs through some calculations to highlight the difference. We now come to corporate notes and bonds. In terms of maturities, there is no formal definition of short-term, medium-term, long-term. But generally speaking, if a security has a maturity of greater than 12 years, then it is referred to as a bond. And if the security has a maturity of less than 12 years, then it is referred to as a note. In the less than 12-year category, if a security has a maturity of less than 5 years, then it is often referred to as a short-term note, and between 5 and 12 years would be intermediate term. You might also hear this term, medium-term note, or MTN. This is a misnomer. It doesn't actually mean that the maturity is between 5 to 12 years. The most important feature, or the defining feature of a medium-term note, is that it is offered continuously to investors through an agent, and very often these have shelf registrations. Because of this, the underwriting fee is relatively low, which makes MTNs cost effective. Next, we talk about coupon payment structures, and we have seen this over and over. We can have corporate bonds which are zero coupon bonds, so they have no coupon. We can have fixed rate coupons, we can have floating rate notes, and as we saw in the previous reading, we can also have the concept of payment in kind. We can have credit linked coupon bonds. I'll not explain each of these terms because we have already covered this concept. Principal repayment structures. Here we can have what is called a serial maturity structure or a term maturity structure. In a serial maturity structure, the maturity dates are spread out during the bond's life. With a term maturity structure, the principal amount is paid off in a lump sum at maturity. Some bonds have a sinking fund provision or a sinking fund arrangement which involves paying off a certain percentage of the principal earlier, and that helps reduce credit risk. Corporate bonds do have credit risk, and as investors we need to understand the asset or collateral backing a given bond or fixed income security. We also need to understand the seniority structure. Corporate bonds might have contingency provisions such as call provisions, put provisions, or conversion provisions, and as investors we need to understand these provisions because some of these provisions benefit us as investors and others benefit the issuer. Issuance, trading, and settlement. Settlement now happens electronically across the globe. Most bonds are traded through dealers who make a market, which means that the dealer stands ready to buy and sell bonds. Investors therefore interact with dealers. Sometimes dealers might interact with other dealers. So this clearly is an over-the-counter market. The settlement typically is T+3 in most jurisdictions, though it can be somewhat longer in other jurisdictions. Bond prices are generally quoted in a basis points format. Now let's take a look at example 6. A loan made by a group of banks to a private company is most likely a syndicated loan. When we have a group of banks, that means it is a syndicated loan. A bilateral loan would be one where there is just one bank involved. Which of the following statements relating to commercial paper is most accurate? Companies issue commercial paper only for funding working capital. Because of this only, this is not true. Only as an interim source of financing, again because of this only, B is not true. Both for funding working capital and as an interim source of funding, this is true. Remember, interim source of funding, this is also referred to as bridge financing. Maturities of euro commercial paper range from, and the correct answer here is B, just something you need to remember. I did show you an exhibit but did not highlight this point, but you can learn it now. A bond issue that has a stated number of bonds that mature and are paid off each year before the final maturity most likely has a... Here term maturity is clearly not the right answer because with term maturity the amount is paid off in lump sum at the end. So the choice is between B and C, and I did not explicitly mention the difference in detail earlier, so let's look at the difference over here. When we say serial maturity, what that means is that bonds are being retired over a period of time. With serial maturity, it is defined in the beginning which bond will be retired at what stage. So when the holder of a bond or when an investor buys a particular bond where there is serial maturity, the investor will know when that bond will mature. In other words, when will he get his principal back. Whereas with a sinking fund arrangement, there is uncertainty because the bonds which are retired are selected through a lottery. If we look at the way this question is worded, the best answer is B. And what I would want you to do here is read the explanation in the curriculum because it illustrates the difference between serial maturity and sinking fund arrangement very well. Section 7 deals with how banks raise funds in the short term. The obvious method is through retail deposits, and this would include both commercial deposits as well as individual deposits. Generally, retail deposits represent the lowest cost source of funding for banks. Next, we come to short-term wholesale funds, and the three broad categories here are central bank funds, interbank funds, and certificates of deposit. Let's understand first what central bank funds means. If you recall, in economics, we studied the fact that when a bank receives money from depositors, some of this money needs to be put into a reserve account at the central bank. Now, if this bank is running low on cash and depositors come to the bank and want to withdraw some money, then what the bank can do is withdraw from its account at the central bank. This is one situation. Another scenario is where the bank wants to withdraw from the central bank, but there is not enough money or not enough funds in its account at the central bank. Then what the bank can do is borrow from other banks. Other banks also have deposits here at the central bank. So there might be Bank 2, which has deposits here, and Bank 2 has deposits that exceed the minimum required amount. Bank 1 can then, through the central bank, borrow from Bank 2. The rate used in this context is called the central bank funds rate. If borrowing happens for 1 day, then we refer to this as overnight funds. If borrowing is for more than 1 day, then we refer to this as term funds. The third and final category of short-term wholesale funds that we look at is shown right here, certificates of deposit or CDs. A certificate of deposit is an instrument that represents a specified amount of funds on deposit for a specified maturity and interest rate. So notice that the period is specified. You might have a 3-year CD or a 5-year CD, and the rate is also specified. Within CDs, we can have two forms, negotiable and non-negotiable. With a non-negotiable CD, the depositor is not allowed to take out money before the maturity date, and if the depositor does withdraw, then a fee needs to be paid or there is a penalty. With a negotiable CD, the depositor is allowed to sell the CD in the open market and get his funds. Next, we come to repurchase agreements, also called repos, and reverse repurchase agreements called reverse repos. This is important because these instruments are used extensively. First, let's understand the definition. A repurchase agreement or repo is the sale of a security with a simultaneous agreement by the seller to buy the same security back from the purchaser at an agreed on price and future date. If you read this carefully, this is effectively like collateralized borrowing. So if we have two parties, A and B, what A might say is that I will sell you a T-bill today for $99.50, which means that A is giving B the T-bill, which is collateral, and B is giving cash, let's say $99.50. And then A says that tomorrow I will buy that T-bill back from you at $99.51. So if this is day one, the next day what happens is that A is going to buy the T-bill back. So B will give the T-bill back to A, and A is going to return 99.51. So this effectively is a way for A to borrow 99.50. The next day A is paying 99.51. The 1 cent is the interest and the T-bill is the underlying collateral. Here is an example from the curriculum. A dealer sells the 2.25% UK gilt. This is the short-term UK government instrument analogous to the T-bill in the United States that matures in 3 years. Actually, since this matures in 3 years, this would be analogous to a treasury note. To a counterparty for cash today. At the same time, the dealer makes a promise to buy the same gilt the next business day for an agreed price. So this is almost exactly like what I just described, but this is from the curriculum. So let's understand a few important terms. What I described is the repo. The transaction was a repo from the perspective of Bank A because Bank A was the bank which was making the commitment to repurchase. From the perspective of Bank B, the same transaction would be called a reverse repo. Repurchase price, in my example, there was a price at which A was promising to repurchase the next day. So that price is the repurchase price. Repurchase date. Again, in my example, the repurchase was happening the next business day. So that would be referred to as an overnight repo where the repurchase is happening the next day. If the repurchase is happening 2 days later, 3 days later, in fact, anything more than 1 day later, then this is referred to as a term repo. The repo rate is the rate which is implied by the two prices, the amount of money that A gets initially and the amount of money that A is eventually repurchasing the underlying asset for. The combination of those two or the difference between those two numbers can be annualized and we compute the effective interest rate. That rate is the repo rate. The next thing we look at is the set of factors which impact the repo rates. And those factors are given right here. If the risk associated with the underlying collateral is high, that causes repo rates to be higher. Term of repurchase agreement, typically if the term is longer, then the rate is higher. Delivery requirement, in the example I just described, the underlying collateral was actually delivered. There might be scenarios where the underlying collateral is not delivered. And as you might imagine, if the delivery requirement exists, in other words, the underlying is delivered to the counterparty, then the repo rate is lower. Supply and demand of the collateral. If the supply of the collateral is relatively low, in other words, the collateral is scarce, then the repo rate is lower. The reason is if the supply is low, then clearly the collateral is valuable. And since the collateral is valuable, the rate is lower. And finally, the interest rates of alternative financing also impact repo rates. When we deal with repos and reverse repos, both the counterparties or both the participants are exposed to credit risk. This is the case even if the underlying collateral has virtually no credit risk. And to understand how this can happen, consider the following situation. Let's say we have a dealer who is the borrower and an investor who lends money. In a 5-day repo, we have a situation where the dealer initially sells the T-bill for a certain amount of money, let's say 99.50. So the dealer gets the money and the investor gets the collateral, which is the T-bill. Now at maturity, let's say that the dealer defaults. In other words, the dealer now needs to repurchase the T-bill, but the dealer defaults and does not repurchase. And at the same time, the price of this T-bill might have gone down. Let's say interest rates in the market went up and the price came down. So now the investor is stuck with a T-bill at a price lower than the price that the dealer had committed to buy back this T-bill at. So that is the credit risk faced by the investor. What about the other situation? Let's say that the investor at maturity is unable to deliver the T-bill. So the dealer still has this money, but let's say that the price of the T-bill has gone up now. So here the situation is that the dealer is stuck with this money, but the collateral that was rightfully his is not being returned, and the value of that collateral is substantially more. So both parties face some credit risk. The way repos are structured though, the lender, in this case the investor, has greater exposure to credit risk. And the difference between the market value of the collateral and the value of the loan is called the repo margin or haircut. In fact, the way this is structured is that the value of the collateral is less than the value of the loan, and that is why the lender has greater exposure to credit risk. And the difference is called the repo margin or haircut. This term is used in the United States. The level of this margin or difference depends on the length of the repurchase agreement, the quality of the collateral, credit quality of the counterparty, and the supply-demand conditions of the collateral. And just to make the relationships explicit, the longer the repurchase agreement, the higher the repo margin. The higher the quality of the collateral, the lower the repo margin. The higher the credit worthiness of the counterparty, the lower the repo margin. And repo margins are lower if the collateral is in short supply relative to demand. Let us look at example 7 now. Which of the following are not considered wholesale funds? And we've just been through this. Interbank funds and central bank funds are both wholesale funds. Repurchase agreements are separate. They are not considered wholesale funds. For a deposit-taking bank, wholesale reserves with the national central bank is a requirement, an opportunity cost, an opportunity to receive interest on excess funds. This is a tricky question. Option C can be ruled out, and what we are left with is A and B. In many countries, putting money in the central bank is a requirement, but this is not the case in all countries. However, placing money in the national central bank definitely entails an opportunity cost, so B is the best answer. A large denomination negotiable CD of deposit most likely is traded in the open market, is purchased by retail investors, has a penalty for early withdrawal of funds. Here again, C is obviously not the right answer. So we are left between A and B. And as we discussed, with a negotiable CD, the depositor has the option to sell this in the market to another investor. So these negotiable CDs are traded in the open market. The best answer therefore is A. From a dealer's viewpoint, a repurchase agreement is best described as, here the best answer is B, collateralized short-term borrowing, and we have talked about this. The interest on a repurchase agreement is a repo rate, and we've also talked about this. The level of repo margin is higher under which of the following circumstances? Higher quality of collateral. Actually, high quality of collateral causes the repo margin to be lower. Higher credit quality of the counterparty. This also causes the repo margin to be lower. The longer the length of the repurchase agreement, this causes the repo margin to be higher. So the best answer is C. Let us now summarize the main points from this reading. You need to understand the different classifications of fixed income securities. Securities can be classified based on issuer. So there we can have government bonds, we can have corporate bonds, and so on. We can also have classifications based on credit quality, classifications based on maturity, classifications based on geography. So there are several different ways of classifying fixed income securities. You need to understand the concept of interbank offer rates. The most well-known interbank offer rate is the London interbank offer rate. This is the rate for unsecured borrowing between banks. The mechanism for issuing bonds in primary markets, there are a few different methods. There is a best effort method where effectively the investment bank is playing the role of a broker. If we have an issuer and investors, in a best effort scenario, the investment bank is trying to broker a deal between the issuer and the investor. Another scenario is an underwritten offering. With an underwritten offering, the investment bank buys the bonds from the issuer at an agreed upon price, and then the investment bank is responsible for selling those bonds to investors. The risk with an underwritten offering is taken by the investment bank. We can also have auctions. Auctions are often used in the government bond market. In the corporate bond market, the methods used most often are underwritten offering and best effort offering. Secondary markets are markets where investors buy and sell bonds to each other. After the bonds have been issued in the primary market, they then trade in the secondary markets, and here investors are buying and selling bonds. When bonds are bought and sold in the secondary market, funds do not go to the issuer. Debt issued by sovereign governments, non-sovereign governments, agencies, supranational entities. So these are all government-related entities. The credit risk is generally the lowest with sovereign governments and non-sovereign governments. Agencies are entities that are created by governments. These agencies also issue bonds. Generally, their credit rating is low, but not as low as the credit rating of sovereign governments. And then supranational entities are entities like the IMF and World Bank. Companies can raise debt in different ways. Companies can either borrow directly from banks, or companies can issue short-term bonds, long-term bonds. Some large financial institutions also issue commercial paper. A repo or repurchase agreement involves the sale of a security, which is the collateral, with a simultaneous agreement by the seller is also the borrower, to buy the same security back from the purchaser at an agreed on price in the future. This is effectively like collateralized borrowing. You need to understand repos because they are extremely common. That brings us to the end of this reading. As always, I want you to read the summary, review the learning objectives, make sure you can say something sensible about each of the learning objectives. We have done all the examples. The examples are very good. I want you to come back to these examples at a later point in time and make sure you can do them. Do the practice problems in the curriculum and do practice questions from other sources.